Hi everyone, I am Punya Aggarwal, ACCA affiliate, co-founder of Being ACCA. In this video, we'll be doing question number 3, case study number 3 of your AA pre-December mock. I have already done the debrief for question number 1 and 2, so you can check out the playlist on the YouTube channel. So let's start. So first we'll read the starting portion, we'll read the first event, and then we'll read the question as well. All right. This is 1st July. It is 1st July 2005. The audit of marine companies nearly completion. So dates are really important. So right now the audit has already almost been completed and the financial statements and the auditor's report are due to be signed the next week. So probably in the July only it is going to be signed. Till now it's not yet signed. However, the following additional information on two material events. So we already know that these two both are materials. So basically, whenever we are talking about ISA IS 1 IS 10, which is 10 IS 10 adjusting events, non-adjusting events, materiality plays a very important role, whether it is going to be an adjusting or a non-adjusting event. So they have right now only told us that it is material, right? Had just been presented to the auditor. The company's year end was 31st of March. So we know the starting date, we know today's date, and we know that the report will be signed the next week, which is probably around 10th July, for example, right? All right. The first event occurred on 10th of April, which is after the year end, because our year end on March, and the event occurred on 10th of April. All right. The springs in a new type of mattress. So probably the company deals with mattresses. The springs in the mattresses have been found to be defective, making the mattress unsafe for use. So that they are defective, the product is defective. There have been no sales of this mattress. It was due to be marketed in the next few weeks. So there's no sale absolutely till now. It is going to be marketed next year, next week. So probably the material, the inventory is at your place only. It has not yet gone to the customer. So that's still a better situation because your inventory, like the reputation does not hamper, the customer is not going to return back you the product, etc. The company's insurers estimate, so basically the insurance company estimate the inventory to be value of, so the cost price of the inventory was 750 dollars has been affected. So this was the amount of inventory that is affected, which is a lot. The insurers also estimate that the mattresses are now only worth rupees to $2,500, which is really less. It has gone down to 750 to 225. So probably if in the market they go and sell it in the market, that is the NRV, the net realizable value that they are going to get, and this is the cost price of the inventory that they have in their warehouse. Okay, no claim can be made against the supplier of the springs. So basically now you cannot go back to your supplier of the springs because it is damaged. Why? Because as this company is in liquidation with no prospect of any amounts being paid to the third party. So already the company is in a debt, is in liquidation, does not have any money. So ultimately, even if you go to the supplier, they won't be able to pay you the compensation for the same. The insurance will not pay. So now the insurance company is also saying that we won't be paying marine company for the fall in the value of the inventory as marine company was under insured. So probably little bit of it would be paid, but they're still under insured, so most of it will not be paid. All this inventory was in the finished goods store, as I told you, warehouse. At the end of the year end, no movements of inventory has been recorded post year end. So before the year end only, the inventory was there at their own warehouse, own place, which was damaged. So this condition now, if you people know the difference between adjusting event and a non-adjusting event, let me quickly talk about that also. So adjusting event happens if an event is adjusting. That means that our financial statements have to be amended or changed. So there has to be a provision, recognized amendment being made in the financial statement if we find that the event is an adjusting event. Now, when does the event get adjusting event and a non-adjusting event tag? Adjusting event is when the conditions of that event occurring existed prior year. Prior to the year end, the conditions existed. Like in this case, we knew at the year end also that the inventory is damaged. Previously also, prior to the year end also, the inventory was damaged only, right? After the year end, there's no movement as such. So basically, that means that the conditions existed previously. That is the reason this is an adjusting event by all means. All right. Non-adjusting event, on the other hand, is when the conditions of that particular event did not exist prior to the year end, so the financial statements do not need to be amended. Only a disclosure is required in the financial statement. For example, your year end is, let's suppose, the 31st of March. Now there was a fire at your warehouse on for supposedly 2nd of April. Now of course, before the year end, you did not know that a fire is going to be there in the warehouse, for obvious reasons, right? You are not somebody who can predict the future. So right now this will be a non-adjusting event. The financial statements would not be changed, would not be amended. Only a disclosure will be there in the financial statement that there was a fire that occurred on 2nd of April that damaged the goods, and this was the amount of the damaged goods. That's all. That's the disclosure that you have to put. But the financial statements won't be amended. That means that you would not have to reduce down the value of the inventory that was damaged by the fire, because the fire condition did not exist prior to the year end. This is the basic difference between adjusting. I've just told you in a summary format. You can also go and check out your videos, etc., to get to more know about it. Or I have also posted some summary notes. So if you want the access to those, please let me know. I'll provide that as well. So let's now read the question. It says ISA 560 subsequent events requires that auditors should perform audit procedures to identify subsequent events for obvious reasons. The period covered by this review for marine company commenced on 1st of April for obvious reasons. Which of the following dates is the end period covered by the subsequent events review? Now this is a very, very important concept, guys. If see, this does not have to do anything with the question as such. It only and only pertains to your conceptual knowledge. So the date when the audit field work is completed, no. The date when financial statements will be approved by directors, no. The straight answer to this question is the date when the auditor's report will be signed. This one is your correct answer, because see, when the auditor signs the report, which is basically will be there on approximately 10th of July, let's suppose, take that date. So once the auditor's report is signed, the auditor is not obligated or does not have any obligation or responsibility in regards to any identification of any further information, the financial statements, because auditor has to do other things also. He or she cannot just put in their efforts in one financial year, right? So there has to be a cutoff period till when the responsibility lies. Like for me also, as soon as your exam gets over for AA, my responsibility ends there as well, right? My responsibility is not towards after that also, etc. My active responsibility is not after that. But yes, if you people reach out to me after the exam and tell me, ma'am, this was the question, how to attempt this and that, etc., I will discuss with that with you, right? But my active responsibility of teaching you, of mentoring you, of telling you your doubts, solving a question papers, etc., ends on the day the exam was done by you, right? So that is the deadline for the auditor also, that when the audit report is signed, you do not have any active responsibility to gather, to identify any potential other misstatements in the financial statements or any other events that require adjustment or disclosure in the financial statement. But yes, if they get to know that there should be an adjustment or there is a misstatement in the financial statement, they have to amend the same, or they have to talk about, or they have to look after the same, right? So that is the reason for this one. The third one is absolutely correct. The date when the auditor's report will be signed. All right. Let's move to the next question now. I hope I'm making sense for you people. Please let me know in the comments down below if everything is clear or no. All right. I think we've already answered this question, but I think we have not read this. Let's read this and then we'll be able to answer the second question as well. So this occurred on 5th of June, which is again after the year end. Production at factory was halted for 1 day when a truck carrying dye used in coloring the fabric on mattresses reversed into a metal pylon, puncturing the vehicle, allowing dye to spread across the factory premises and into a local river as well. So dye, as you people know, is very, very harmful. Has lot of chemicals, so if it is excreted into a river, a flowing river, it can cause a lot of water pollution, lot of environmental damage. That is the reason the environmental agency is currently considering whether the release of the dye was in breach of the regulations or no. So if it was, you have to recognize provisions. There have to be fines and penalties for the same, not provisions. Fines and penalties will be there. But this event is a non-adjusting event. Why? As I just explained to you, the you prior to the year end, you did not know that the truck is going to collapse and dye is going to go into the river and everything is going to get spilled. Of course not. It's an accident, right? So that is the reason this is a non-adjusting event. That what the question is asking us. By clicking on the relevant boxes, event in 2 will be classified as adjusting or non-adjusting as per IS 10. Event 1 is adjusting, as we have already discussed, because the conditions existed previously as well. Event 2 is non-adjusting because the conditions did not exist prior to the year end. It was an accident which occurred after the year end, right? Very simple, very easy. If you know your standards really well, that is the reason. If you have seen any of my videos, the previous videos as well, you would know I focus a lot on the standards, which is your IS, IFRSs. These two are really important because if you do not know these these very nicely, you probably might not be able to answer all the questions really nicely. Here also, if you did not know about IAS 10, you will not be able to answer the previous two questions, which is really important. All right. So let's move with the next question. Okay. Okay. Indicate by clicking on the relevant boxes in the table below whether each of the following audit procedures are valid or not. So these are basically your audit procedures that the auditor might be doing. So we need to see if they are valid or not in relation to the event 1. So only and only to the event 1, which is basically your inventory case. So we need to see if these are valid or no. Let's see. Okay. Obtain confirmation from the insurer, so basically the insurance company, of the amount recoverable under the policy. So now if you see over here, it said that insurers will not pay marine company for the fall in the value as it was under insured. So again, it is valid as auditor because I see the company, the insurer is saying I will not pay. But I as an auditor, or basically the management is saying that my insurance company is not paying me. But I as an auditor, I have to confirm, take a valid confirmation, external confirmations, etc. So I have to confirm from the third party because we know that the third party confirmations are the most relevant confirmations. So we need to see, we need to cross verify that whether the company is telling me the truth or no, that they're actually not going to receive any recoverable amount, right? So I am going to do the direct confirmation from the insurer only of the amount that they're going to receive under the policy, and if there's any amount that they probably can receive. So this is valid. Next one, inspect correspondence with the supplier concerning their solvency. Again, this is again a third party confirmation because I am directly going to the supplier and asking them if you are insolvent or solvent or what is the situation. So right now also I've gotten from the management, I've gotten the information from the insurance company, but I also need to do my own procedures, right? So I am going to take a confirmation from the supplier only and asking them what is the solvency position. Will they be able to pay the amount to the company or no? So this is absolutely valid. Next one, recalculate the net realizable value estimate for the inventory. Absolutely yes, because the net realizable value, which is this value, has been calculated by the insurance company. You as an auditor, you have not calculated. Probably they have calculated it wrong. So you have to recalculate the NRV and check if this is the actual one or there's a further increase, further decrease or further increase to the value. So this is again very, very valid. The next one says, review post-year-end physical inventory counts of the mattresses. Why are we reviewing the post-year-end physical inventory counts? We don't care about the post-year-end inventory counts. We care about the pre-year-end inventory counts because this happened with the pre-year-end inventory that we had for the mattresses, which was damaged. It was pre-year, it was not post-year end. So we're not going to review the same. This is not valid. Next, inspect subsequent cash receipts from the sale of the defective inventory. Again, subsequently, it was till now when the auditor's report is getting signed, we have not received any cash, we have not made any sales because they are saying no sales have been made. So till now we have not received any cash. So how are we going to inspect the cash? Again, does not make any sense. So that is the reason this is also wrong, not valid, right? Next question, let's move. I think this was pretty simple. Let's move to the next one. All right. Which of the following, just a minute. which of the following audit procedures should be carried out on event 2? So which of the procedures you have to carry? So out of these three, you have to carry out the procedures. Which are those two? Let's see. Inquire of the directors. So you have to inquire of the directors whether they will recognize a provision for a fine in the financial statements. Again, guys, this is little weird to me because just now we discussed that event 2 is a non-adjusting event, and we all know and that if it is a non-adjusting event, we will simply put a disclosure. We do not have to recognize any provisions, any fines, nothing we have to do with that, right? We only need a disclosure. So why are they inquiring whether there is a provision in the financial statement for a fine or no? We don't have to recognize the provision, right? So that is the reason this is not correct. The first one does not make any sense. So this is this gone by. Ideally, now as per the elimination, now I always say that sometimes elimination does work, but always I say your concepts have to be crystal clear. Here, yes, I would say that second and third is directly correct as per that, but let's also understand why second and third are correct. Obtain board minutes to determine the extent of the damage. Again, you have to understand the extent of the damage to see how much damage was made. So it is absolutely perfect because ultimately, if it is small damage, higher damage, how are we going to see for how much disclosure is going to be there? So we have to get full information at least of the damage that has happened. So this is absolutely correct. Third one, inspect the environmental legislation and in any interim reports from the environmental agency to determine the extent of the damage. Again, we have to, because these people are going to see the environmental breach of the legislation as well. So we are also going to inspect the same to see if there are any interim reports that have come by to see how much extent of damage has happened to the river as well, right? So this is absolutely correct. So 2 and 3 are absolutely correct in this particular case scenario, by the elimination also and by concepts again also. All right. Let's move to the last one. All right. Okay. The auditor's report was signed on a planned date. So again, if it is 1st July, so probably around 10th of July, it was signed. And an unmodified opinion was issued. So okay, which is okay. Okay. It is now 20th of July. So after the audit report has been signed, now is the date. The annual general meeting is to take place on 21st of August. So there is going to be placed an AGM after the report has been signed on 21st of August. The environmental agency has issued a report stating that marine company is in breach of environmental legislation with a fine of $900,000 will now be levied on the company. The amount is material to the financial stream. Of course, it is material. It is a lot of amount, right? Okay. Which of the following audit procedures should not be performed in respect of this fine? So probably out of all of these four, all of these have to be performed, but one is there that we do not have to perform, or we cannot perform, or we should not perform, right? Let's see. Discuss with the matter with the directors to define the course of action. Again, you have to discuss it. So now, because the report is signed, your duty as an auditor, as I said, is over. Active duty is over, but now the conditions have come into place wherein there's a heavy fine implemented on the company, which is material. So you as an auditor, you have to discuss the course of action. How are they going to move ahead with the same, right? What are they going to do? So this is absolutely correct. So this is not your correct option because this is a correct statement that they will perform, and we have to see not to be performed. Next, determine whether the financial statements need amendment. Again, you have to see, because this is a material amount. This amount is material. We need to see if there should be any amendment because it is material. So we need to see if the amendment is required or not. So this is correct. Third one is, if the directors amend the disclosures in the financial statements, add an emphasis on matter paragraph in the existing auditor's report. This is a wrong statement. If you understand the concept really well of the reporting, the reporting chapter that we have in the audit syllabus, you know when the auditor's report is signed, it is done, you cannot amend or change or add or subtract anything in that report. You have to redraft the report that you have, or you have to redate. There were two words in the chapter, redraft and redate. You have to use these two words in this particular case scenario. So existing report cannot be added, cannot be subtracted. You have to redraft, redate the auditor's report with the amendments that you have to include. So this is not a procedure that you have to follow or that you can follow. Next one also, let's see. If the directors decide not to amend the disclosures in the financial statements, speak at the annual general meeting to inform the members of the fact. Absolutely, yes. If the management, see, if you require an amendment in the financial statement, which is most likely the case, and the company is saying, no, we won't amend the financial statement because they have their own interest. Because if they, because it is an expense for them. So if they increase the expense, they would have to decrease their profits. So that will show a negative position of the company, right? So they are saying that we won't be amending the disclosures, nothing we're going to amend in the financial statements. So if they're not going to do so, the auditor has the responsibility, accountability to go to the AGM, which is going to take place on 21st of October. 21st of August, I'm sorry, to inform the members, the AGM members, of these facts that the company is not amending, and that an amendment has to be there because it is material, right? So with this, we are done with section A debrief. I have already done the debrief for your question number 1 and 2. You can check out the playlist on the YouTube channel of Being ACCA. Please let me know, guys, if there's any other doubts, any questions in regards to this. We are now be moving to section B also. I'll be doing the debrief for the section B also. So stay tuned for that, and do let me know in case you have any doubts, any questions. I'll be more than happy to help you and guide you through that.